Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. We're here for another week, and man, we've got a lot to share with you today on this show. Ross, what's up, buddy? How you doing?
Hey, Michael. Good to be with you, man. We got some fun topics today. So you ready to dive in?
I'm ready to dive in. Let's get going.
So, we always try and have a little bit of a sports theme and like to talk about different sports figures and popular people. And so I came across a really interesting idea. This was shared in my feed this week. And it basically came back and said, it was kind of comparing what people's jobs were versus where they made the bulk of their money or had a great investment. And so here was what came over the feed. It said, Steve Jobs made more money from Disney than from Apple. It said, George Clooney made more money selling tequila than acting. George Foreman made more money selling grills than boxing. And Dr. Dre made more money from beats than making music. And it's obviously that is, we know what those results were, right? Like the George Foreman, everybody knows the George Foreman grill. It just became a huge, they were everywhere. Probably 10 years ago, 15 years ago?
They were all over the place for sure. And it's kind of astonishing to think that he made more money selling those grills than he did boxing.
Because he was in some of the most iconic fights in boxing history.
Sure.
And was a fantastic boxer. Became world champion twice because he kind of ended his career and then came back because of some bad investments, because he basically was broke. And he started boxing again and became heavyweight champion at age 45. I
remember that fight. He was fighting, I think Michael Moore, the guy's name. And people were like, he took the fight. Michael Moore was the heavyweight champ. And right. A lot of people thought, like, what are we doing? You're fighting an old man. And George Foreman was like, y'all don't understand. He's like, and Foreman was always known as a big puncher. And he always had a puncher's chance. And sure enough, like he weathered like getting beat on for a little bit. And then he just clubbed Michael Moore. And everyone's like, well, there you go.
So I thought this was a funny backstory. I did not know this. Okay. So I started doing a little research on how did the George Foreman get to represent this grill? And believe it or not, this was in the mid 90s, 1994. George Foreman was regaining popularity, but there was also a very, very popular wrestler from the World Wrestling Federation by the name of Hulk Hogan. Everybody remembers Hulkamania, right? Do you know Hulk's business manager gave him 3 options for a product to endorse? One was a blender, one was a meatball maker, and the other was a grill. And you know what Hulk chose?
He didn't pick the grill. I know that.
The Hulkamania meatball maker. And he passed on the grill. And the business agent shared a client. That client was George Foreman. George Foreman agreed to represent the grill and ended up making something reported over $250 million. Wow. So the big picture story, I wanted to share that because one, obviously these individuals never really quit their day job, right? George Clooney's still acting. George Foreman was boxing at age 45. Dr. Dre, I'm sure, is still making music, has been making music, but they had these side businesses, these opportunities that came into their world that they capitalized on and made enormous money. And so the thinking is, never quit your day job, but keep your eyes open for other income opportunities in areas that interest you, that you have a particular skill in, and that just become available to you.
Or you could just be a heavyweight boxing champion and get endorsement deals. It's like either way, right? Whichever path makes more sense for you, you go that way.
But I guess you never know where that next opportunity is going to lead and what it might make for and what your outcome might be.
No question. Well, I will take your talking points, and I'll transition us into this segment that you want to call "Investing is Hard," right? So we want to start doing
a recurring segment. Investing is hard.
And by no means are we trying to throw shade at anybody, but we want to teach and also enlighten folks about just the perils that come with investing and money and all the different emotions and biases and everything that comes with investing in capital markets. And so I'll kick this segment off with, I'm actually doing some graduate work right now, and I have to write a paper. I have to do a book report. And one of the books that I've chosen is a book I read several years ago. And it's a book written by Gary Belsky and Thomas Gilovich, Why Smart People Make Big Money Mistakes. This is one of the first books I read when I was getting into behavioral finance, and it kind of kicked that off for me in a big way. And one of the passages in here is you can know too much. Knowledge is power, but too much information can be destructive. Studies have shown that investors who tune out the majority of financial news fare better than those who subject themselves to an endless stream of information, much of it meaningless. And I just thought, man, is that not like a perfect summation of what we're dealing with right now? I mean, this book was written years ago. Right. And if you think about how plugged in majority of people are, right? I can't say we all, but majority of people are plugged into 2 to 3 different social media platforms. My parents' generation, probably your parents' generation, they don't do social media as much as they do, like just have the cable news, whatever of their choice running in the background. It's just like constant bombardment of information, and how that does not enable us to be, we think it's enabling us to be informed and to make better decisions. But the data shows that it does the exact opposite. It helps us, it makes us more emotional, and where we make worse decisions.
Right. It increases the impulsiveness, right, of investing decisions when maybe the best course of action is just to be still. And yeah, there's noise, and there's constant information being bombarded on the screen to create sort of a decision, right? Or to get you thinking and to move you emotionally to another place, when maybe we just kind of take a deep breath, think about why we're investing in a particular business, what that business does. Are we still comfortable with how it's operating and how it produces money, and kind of put all that aside? I mean, we referenced a 200-year-old book last pod that was talking about behavioral investment. And it doesn't change, right? The behavioral patterns are consistent, even though it's a completely different era and a different way that we're investing and getting knowledge. The outcome of how we make decisions is still very consistent over decades.
No, I would agree with that. And, I think about this political spectrum, and it seems like everything just continues to push us to, and I'm guilty of this. Most of us, I think, if we're being, objective about our own selves, everything is pushing to like this binary, good versus evil, red versus blue, market, we're going to take the market off, the market's going to crash and crumble, and we're losing discernment and really being able to kind of think through like next level thinking on multiple fronts. And so our brains, we're just not wired to do that cognitive heavy lifting. So we shift to like our defaults, our little heuristics, our rules of thumb, our all of our things, which data continually shows us they short circuit our success. And so that's where I wanted to lead with. And I think you had a couple of funny ideas to share here, so we'll buckle up and go for that ride.
So there was some honest posting that happened through my feed this week, where one individual just kind of made the claim. They said, "Hey, listen, investing is hard, right? This is the segment." They had talked about buying AMD. That's a stock, AMD stock, at $9 a share. Sold it for $20 a share. Felt great. Doubled their investment, and now it's trading at $83 a share. Someone else chimed in and said, well, hey, that's okay. I bought Netflix at $12 a share, sold it for $30, a nice profit, right? $18 a share profit. And of course, now Netflix is trading for $543 a share. It takes a lot of commitment to stay invested through that type of enormous return and not get shook or not think the end is imminent, that it can continue to go. So, Michael, there's a couple of out there. Do you have one? Any investment regret that you go, man, I had this and I was right there?
I don't know. Well, yeah, I mean, so yeah, for sure I can share. I have two things that come to top of mind. Number one is I can still to this day picture myself sitting at my desk at the firm we used to work at, and this was years ago, but seeing the breaking news about this new internet money called Bitcoin, and it was like now available, and I just kind of turned my nose up at that. And normally I'm like, let me just throw a few bucks at it, just see what happens. And I've, I mean, all of us have done the math. I mean, $500, $1,000 investment in Bitcoin when it was, 7 cents per would be, insane wealth at this point instead. So, so I remember that. And then I also, I tend not to look at IPOs at all. Most of the time, I especially in this environment, last couple of years, I tend to ward off looking at IPOs. But I did put a little bit of money in Facebook when Facebook went public, and
which was like $40 a share.
Which, yeah, that was the price. That was the price point that I actually was able to buy some shares at. And then, it went down, I think, to 17, 18 a share. And I thought, got duped again. And so I just took my lumps and I exited that. Thankfully, it wasn't it was more of a dipping my toe in the pond. I didn't put a significant amount of money in there. But I took, instead of just saying, well, let's just see how this goes, I started looking at the company like, how are they going to make money? This is dumb. People don't do anything but argue and post videos on Facebook. Like, this is just kind of silly. And, obviously, if I'd have held it, I would have been, it would have been a nice investment.
So $17 to $264 as of today. Well, I think Bitcoin is one that we probably all have some people in our lives that work early to the Bitcoin game and just sort of used it as almost like a novelty, right? I mean, several years ago, where it wasn't uncommon, especially if you had a technology background and you were familiar with how to store it, you weren't nervous about trading it or being duped or taking advantage of, then it was pretty frequent that people would just do it for fun, right? So they'd use it to buy any kind of low level product or service or sale or trade with somebody that they wanted to. And I remember having a friend that at the time probably probably traded somewhere between 50 and 100 Bitcoin. And it doesn't seem like much. I mean, at the time, like we were kind of chatting before, I was like, that's almost like going to the casino and carrying around, some casino chips. I mean, you gave $100, right. You got $100 worth of chips. You walked around the casino, you threw them around. You knew that at any point in time, you could walk back to the cashier and get your money back. And that's really what it was kind of used. The price wasn't moving that much. And so you didn't have a lot of concern over using some to buy anything because it was basically worth what you were buying it for. And you didn't know, nobody knew that it was going to explode and become this, whatever you want to call it, store of value or
only the truest of believers thought that.
Right.
And I would say the jury is still out for a ton of very smart people who are not convinced on Bitcoin. But, do you have a story?
100 Bitcoin is worth $1.1 million today. I'm like, can you imagine this? You can't even think about it, right? You just have to block it out of your memory. No, I couldn't. I was kind of going back through the memory banks of trading activity. There wasn't anything that really stuck out to me. I'm sure I'll have that moment before long. But moving on. So that's investing is hard this week. Never beat yourself up. There's a lot of folks out there that have made a return and left money on the table.
But this is, one of the things I will just, bookend that conversation with is saying, this is one of the areas where I truly believe the value of an advisor. And the reason being is every person has their lived experience, but advisors have the shared knowledge of lived experiences across, hundreds, sometimes thousands of investment stories. And collectively, that wisdom compounds over year after year after year, where, it's not to say that you specifically as an investor can't learn these lessons over time, but our period of learning and wisdom accumulation is condensed considerably because we're dealing with this day in, day out, and hearing all different types of tales and investment stories, planning stories, and so that collective wisdom benefits clients just from having someone that they can trust and they objectively can talk through different decisions and help them make choices. That's just my view on that. So next up, you were telling me before we were talking about the show, you're saying that you saw an interesting tweet come out this week about J.P. Morgan, and I think this is indicative of the way that our economy is shaping, and it kind of dovetails with some of the jobs ideas and conversations we were having over the last week.
Yeah, so J.P. Morgan Asset Management puts together a pretty good slide deck. And this particular slide that I'm looking at focused on what they call sector share of GDP, employment, and S&P 500. And I want to hone in on the technology sector. And so, as we know, the technology sector represents a pretty large portion of the S&P 500. As of the print of this, which was September 2020, they calculated the technology sector representing 39% of the S&P 500 value. But conversely, if you look at the share of employment, it was 2%. So it has enormous value, recognizable names, right? Household names at this point, and a very slim percentage of our actual employment is coming from that. And go for it.
Well, I think that speaks to just the power of technology and how it speeds up so many things and it allows efficiencies to create where in the past you needed people, you don't necessarily need that human capital to operate. And so one of the things that came out this past week that I just read, it was a part of the economic thing that First Trust puts out each week with tracking of the coronavirus. And it was, and part of that, it said a recent survey by Cisco of 1,569 business executives, knowledge workers, and others who are responsible for employee environments in the post-COVID era concluded that working from home is, quote, the new normal, with over 90% of respondents saying they won't return to the office full time even after the pandemic is over. And so you can thank technology for that type of disruption. Now, I think 90% is probably high. I think they'll probably be, there's massive disruption happening right now. I think there'll be some settlement, and those numbers will come back down, because I think obviously there are going to be people that can manage themselves very effectively at home, and then there are going to be people that probably need some structure, just the routine of going to the office, being present, doing your work. But I think there's going to be this growing segment of employment where there's flexibility, where you can work remotely, but maybe you have to be in the office once or twice a month for specific meetings. And I was having a conversation the other day, and the two things that I was saying to someone was, number one is, can you imagine how this will unlock people's geographic locations for where they work? If you can find jobs where you can work remotely, you no longer have to live in the city where the headquarters is. You can work, in rural communities. You can work in the suburb. You can live in the suburbs. You don't have to be locked into a location just because of your employment. And then number two is, I've been saying this, I feel like jobs are starting to flatline in the recovery. And I think it's because a lot of these jobs that are, that were moved out or immediately left, companies have had to downsize and they've had to become very efficient to survive. And there's going to be technology that gets put in place of some of these workers, and some of these workers won't get to go back to the type of job they were doing previously.
Right. This story is being written right now as we speak, and we don't know how it's going to end yet, because there's a seismic shift in what could happen within the economy. For example, we could here locally in a suburb of Charlotte, North Carolina, we could benefit temporarily from an influx of people, right? Because it's we're especially for retiree age, retirement age folks who are on a fixed income, who aren't working any longer, right? They don't need the proximity to a particular corporation or job, can choose where they want to live, right? And do you want to live in a state where you're paying $10,000 in property tax a year or $3,000 in property tax a year?
Absolutely.
Do you want to live in a state that is taxing you for Social Security income or one that's not? And those decisions become pretty simple. But what you alluded to and what is potentially going to come on the horizon is working professionals leaving. And when working professionals start to leave and flee to low tax states or better living conditions, you want to live in near a coast or whatever that might be. I think this is a migration we have not really seen yet in obviously high tax states that are having budget issues. We could see this snowball, and I'm not really sure how this is going to end. And I'm nervous, very much so, about some of those areas losing working professionals that can have the freedom now to move.
I think it's starting. And the reason I say that, I'll give you some anecdotal boots on the ground evidence. Okay. So this morning I was over at Dr. Black's office getting my chiropractic adjustment. So
Sure.
Shout out to Dr. Christopher Black for Health Source Chiropractic. But that's where I was. I was getting my chiropractic adjustment, and I was talking to him, and he was telling me his daughter is she's going to become a chiropractor as well, and so she's finishing up school, and they're getting ready to move her. And he started telling me about his experience trying to rent a U-Haul. And he said, I thought I could get one right over here. And he said, no, I'm having to drive like to the other side of TGK, which isn't far, but it's probably 30 minutes out of his way to go get a truck. And he said, man, what's going on? And he said the lady that he was dealing with said, we're having all kinds of logistical issues right now. She said that right now in the state of California, he's like, you cannot get a U-Haul. You can almost not get a U-Haul at all in the state of California. He goes, 90% of the U-Haul rentals have been one way. So right. we've heard and we've seen people talking about people leaving California and possibly leaving New York, and who knows if this is just a short-term trend. But I think that with this disruption that we're seeing, obviously, some of these states have been more punitive with their measures with dealing with the virus. I think some people have just said, you know what, enough's enough, and we're out of here.
Right. And what got us started in this conversation was how much, just going back to technology, how much revenue and how much just growth these companies can experience with a fraction of the employment that other industries have needed in the past to grow, right? A Walmart can't grow like that. They have physical locations. They have staff that staff each of those locations. There's employees everywhere. And a technology company that does not have to grow their footprint and just can grow their sales they can generate expanding revenues without expanding their employee base. And that's scary. It's scary about the future of employment opportunities in 5 years, in 10 years, if it's not already right now. And if we continue to see more of this shift, particularly like you said, if we're working from home, we're not traveling as often, there's less demand on commercial real estate potentially, there's less demand on all the things that go along with that. And all the people that work to support a building or the type of expense that a company might have to employ to get all the right equipment in that building, et cetera. What does this mean for our jobs market down the road? And that's, again, I don't know that story is really fully written either, but that's a little unnerving.
Well, I was reading, and I can finish up with this, but I was reading, Tim Dye, who works, I think, at the University of Oregon, but he has a blog called FedWatch, and I started reading it, and I think he puts something out almost daily. It's full of information. It's pretty technical, but I like to read his insights, and he follows the movements of the Federal Reserve and different things, and he says, and he provides some commentary. And, he was recently on, Josh Brown's podcast, and they were talking about this need for stimulus, and why did Trump walk away from doing the stimulus package, and I won't get into the political narrative that they discussed. However, they made a point, and this is what I have continually felt myself, is this environment, this is the very type of environment where income inequality and wealth inequality is exacerbated, because a lot of your, white collar jobs, a lot of your people who have college degrees, they're doing okay. I'm not saying everybody's doing fantastic. It's not what I'm saying, but we're weathering. We're trying to limp through this thing. But a lot of people that work manual labor jobs, or they're in service business, those jobs have not come back, or a lot of these places have been closed, or they're being laid off, and now they're sitting at home. And those are the families that really need the stimulus. They need the extended unemployment. They need the stimulus checks to kind of get through this thing. And, we're in this mode of political infighting. And so the very issues that, everyone's saying that they're trying to solve, they're exacerbating them by not acting on this, and it's creating bigger problems for the future. And the longer that we force businesses to figure out how to survive in this type of environment, they will figure it out without these people. And then those jobs don't come back. They're like, no, our profit margins are fine. We survived. And then it becomes, do we want to grow? Can we scale growth? And so you see a much longer labor recovery as a result. And that's what I think is happening right now.
Right. All right. What else we got?
Well, I wanted to talk briefly about something that I found. I was reading some more economic commentary from First Trust again, and one of my economists, is Brian Westbury. I think we have a lot of similar views, but I think Brian is one of those voices out there. He's not afraid to kind of say what he thinks, and will look to back it up with data. But they put out talking points for September. And he said in September, the Federal Reserve stated it expects to hold short-term interest rates near zero until two things happen. Number one, the U.S. unemployment rate is back to normal, which he's saying around 4%. And I'm like, anyone that's trying to say we have a normal unemployment rate, I think it's just speculation at this point. What's going to be normal, we don't know. But number two, inflation is running at or above 2%. And that was a big shift that the Federal Reserve made. Instead of saying we got a 2% target, they shifted to a range where they've even said we may allow inflation to run over, may go over our previous target just to avoid having to raise rates too quickly. And he's saying the Fed does not expect to achieve both of those goals, full unemployment and inflation at or above 2%, until 2024. So one of the motivations is obviously to commit a near zero interest rate environment, so that to incentivize risk taking. So we want to get people, to disincentivize people from just sitting in cash. And I think this is kind of going back, if you remember back to financial crisis times, how many people are like, man, I'm getting nothing on my cash in the bank. And at what point is it more painful to sit in cash than it is to, potentially have money at risk in the market?
So there's not as much competition for stocks as there used to be, right? Even 15 years ago, if you could get a reasonable bond interest and you could get more, let's say, stable price movement from a bond and make 3, 4, 5, 6%, then some people would choose that versus having a potentially higher return in a stock that's going to offer more periods of extreme volatility. And so as the bond interest rate continues to fall, it's much more difficult to make any real money. I guess I said interest above inflation in high quality bonds. Then the appetite to move into stocks can grow, right? Because there's just not as much competition for those dollars as there used to be. And I think that's the Fed's point, right? Is to stir economic activity. It punishes, in some cases, people with a lower risk tolerance that want to earn a reasonable return without taking the type of price risk that they can in a stock. And over time, as those bond prices have continued to fall, it has probably pushed more people into stocks than they may otherwise want, than they may otherwise choose to be. So it's probably working. What do you think?
I think it's going to create an environment where people need to be extremely clear about risk versus reward, because obviously we all understand that 2% is no fun when you think you can get 3%, and 3% is no fun when you think you can get 5%. But when you kind of default everything down to zero as your starting point, it's like, well, what additional amount of risk? And when I say risk, we all think about downside risk. There's risk to the upside too, right? I mean, the market could go up and you could be rewarded, but so I should probably say volatility. What additional amount of volatility can you accept? And this is where I think, markets like this really distort a lot of things. And one of them being is people getting further and further out on a limb than they may be comfortable with, because they're seeing, the rewards happen. Obviously, lots of stuff happening right now. The Fed's propping up, the markets. They're being extraordinarily accommodative. We're going to get more stimulus. We don't know who's going to pass it. That's the big thing. We don't know if we're going to see a Biden administration, and Biden administration is going to pass the Pelosi's package, which was a $3 trillion spending bill, or if we're going to see, Trump back in office. And it doesn't matter if Trump is reelected, they're going to sign a stimulus package because they can't just prolong
We believe.
Yeah, they will pass something, right? So, we're too close to the election and everything is hyper political, but I think Trump wants to pass something. And this is one point, and I'll finish up with, we still may see something, but one topic that's come to the forefront again is they now have this Supreme Court seat, confirmation hearings. And I think McConnell is basically telling Trump behind closed doors, hey, do you want me to work on, this confirmation, or do you want me to continue dealing with this? He said, because I can't do both in, a 20-day time period. So I think the prize for the Republicans is going to be that Supreme Court seat. And, people can agree or disagree with that, but I think that's just the political nature of where it's at. So, what I think, to answer your question, I think we're kind of in a similar environment that we were back at the end of the financial crisis. Obviously not the same, but I think people are going to have to be willing, if they want to see their money have real returns net of inflation, they're going to have to be going into assets that can actually provide that. And I don't think that's going to be cash.
Yeah, we'll see what next year brings for returns. There's
next year, you mean like next week?
Yeah, there will be bright spots in the economy. The concern we have is that there's fewer sectors of our economy that deliver bright spots, and there are some sectors that have been hit harder over this past year through whether it's COVID restrictions or just the natural evolution of a sector that we're seeing less and less opportunities. So I think understand how you're invested and where your risk tolerances are and preferences, and be diligent in sticking to your plan.
Absolutely. So for those of you who made it through with us, thank you as always for listening. Find us online, find us on iTunes, find us on Spotify. Give us a note, shoot us an email. We can email us at themoneyhuddle@vcplanning.com. We'd love to get your feedback. We'd love to hear topics you'd like us to discuss on the show. And as always, thank you for listening. We'll talk to you next time.